Folks, I want to talk about earnings. So, Target reported earnings. They were not as good as expected. This is not good. This is actually very negative. Why? Because Target is a leader in the retail space. And retail, as I've said many, many times before, makes up between 70 and 80% of the gross domestic product, the GDP. So if retail sales, especially if someone like Target is slowing down, we may see a slowdown with Walmart, and we may see a slowdown with other retailers. So far, it's limited to Target, and we are still, I'm looking at the SPY retail ETF, it's still trading above the 50-day moving average. So thus far, retailers are still trending higher, but we're going to keep our eyes on the retailers. Very, very important. Now, let's talk about earnings that came out. The big things right now are bank stocks. Bank stocks are reporting. So we had Goldman Sachs, Bank of America, those are the biggest. Bank of America numbers came out better than expected. The stock has been trading sideways for about a month right now, and it had better than expected numbers. And what does the stock do? It trades lower. Goldman Sachs, on the other hand, and this is very negative, had negative numbers. Numbers were below expectations. The stock started a downtrend, as you could see here. It's been moving down since January. And I'm assuming the reason it's up right now is because it's pricing in the majority of what's there. But Goldman Sachs had negative earnings. Now, Goldman Sachs is one of the most important companies when it comes to U.S. economy. So we're going to have to pay attention. But again, Bank of America is good. Goldman's a little bit off. So we got to see how U.S. Bancorp, Wells Fargo, and a couple of others came out and look at the whole thing. But what I don't like, what I really don't like, if you look at the Invesco ETF that tracks banks, and this tracks, here, let me show you all the banks, the profile of this so you can get a good picture of what banks we're looking at. Let me look at the constituents. Always look at the constituents, so when you're looking at the ETF, you'll know what parts make it up. So let's take a look. So here you go. And this is based on the percentage. Citicorp, Bank of America, JP Morgan, Wells Fargo, US Bank, all the big ones. These are 1, 2, 3, 4. These are the 5 biggest banks, and they have the biggest market cap. So if you look at these 5, you probably get about 40% of this entire index. But the reason I'm bringing it up right now, and pay attention, this is important. If you look at price data, let me just back up one here. I had it initially here, but I decided to be adventurous and show you the constituents. But if you look at the 50-day moving average, which should be on this chart, we are trading for the first day below the 50-day moving average on bank stocks. Bank stocks are huge, and interest rates are low right now. So it's hard for bank stocks to make money, and this may pull down the overall market or begin to pull down the overall market. I mentioned before, the overall market is grossly overbought right now. We are, in the last 5 years, right now, we've only been this overbought 2 times before. Yes, 2 times before. So the fact that we're moving down on bank stocks is a major, major, major importance. Although retail is still looking good, but bank stocks, and remember, some of them are better, came out with better than expected numbers, they just can't maintain. This is a descending triangle. If you could see the downslope here and a flat line here, and I'm expecting this price level to possibly hit the 200-day moving average before it's all said and done. This is the RSI, and we're not oversold just yet. We're only at 35. By the time we get down to the 30-25 level, there's a good chance we're going to be somewhere in the twilight zone, which is between the 50-day and the 200-day moving average. So I'm not really happy right now with earnings. Also, in the last 2 months, the number for this quarter, we were expecting flat earnings. We're now expecting negative 3.7% for the same quarter over a year ago. So the number has been revised substantially lower. For the first quarter of 2020, we're expecting positive revenue and growth. But right now, we're seeing negative numbers as the projection. Hopefully, first quarter's number will be better than expected, and we will see some upside. But right now, I don't feel a lot of confidence in the large caps because of what I'm seeing in the banking sector, the 200-day moving average, and Target. I'm not happy with what I'm seeing with Target's numbers. As a matter of fact, right now, I want to show you something interesting. Pay attention to this. This is the SPY. This is the S&P 500. If you look here under the S&P 500, under profile, and this is something you should pay attention to. If you look at the PE ratio, price versus earnings ratio, it's at 19.67%. If you look at microcaps, small cap stocks, I want you to see this for yourself. The PE ratio is at 13.4. Also, large cap stocks, what have they been doing for the last 9 months? They've been moving straight up. They are so overbought right now, it's ridiculous. Small caps and micro cap stocks, what have they been doing the last year? They've been consolidating. They've been sitting there on the sideline, just resting, and waiting for price data to move higher. And they're moving higher in anticipation of China and US trade war being resolved and our trade differences being resolved with China. It may take a little longer than expected, but I believe, and remember, small caps are more speculative, so they tend to price things in ahead of time. So don't be surprised if you see small caps substantially outperforming large caps over the next several months. PE ratio's better. They're not overbought. I mean, grossly overbought. Large caps are grossly overbought. Earnings are not as good as could be. So I'm seeing a lot more upside. I mean, huge upside in micro caps and small cap stocks, and a cool down in large caps. Not a major cool down, but a reasonable size cool down that should take us to a congested or a pause in the trend for a few months. Hope that helps. Folks, tomorrow is a big day. I mean a huge day. I'm so excited I can barely contain myself. So what's happening tomorrow? Well, I'm glad you asked. I'm revealing the details of the only trading system in the world, as far as I know, that can literally double your portfolio in less than a year without trading a single option. That's right, no options. It's called Cyborg, and it only trades the market's most explosive stocks. These are stocks that are often overlooked or avoided by individual investors, and that's a big mistake. Why? Because they're cheap right now, and many of them are growing earnings by triple-digit year over year. This is the solution to trading the S&P 500 right now. It's overbought, and the fundamentals are deteriorating. Large caps are going to be flat for a while, but small caps are going to be cooking with gas. It's all happening live tomorrow, and if you register now, you'll also get my #1 trade during the broadcast. You really don't want to miss out. Click the link below, and I'll send you an email to my private trading room tomorrow. Don't miss out. Learn to double your money with small caps.